right, thanks for the memories is the topic today. Thanks for joining me. All right, so let's review. The last video I did on YouTube, I was saying don't give up on me yet. The market looked as if we could have formed at equal and opposite, and I think on the video we stated I'd like to see how the market, if the advanced decline after 130 still holds up positive in the S&Ps, then we have a strong shot of a breakout. Well, what happened? Well, President Trump came out at around just slightly after the lunch hour and imposed the announcement of 10% tariffs on the market. Let's take a look at our strategies. First and foremost, the spider system went short, and you can see it right here. Now, the VIX is not long the position because now it just kind of went straight off the charts. The model that we use on the 120, if I may be so bold, is a short-only strategy. It was short. It got out. Its performance, I mean, again, there's everyone that can grade everything, but the bottom line, this is a overall historic performance, at least going back since 2018. Month of December is not so good because it's taking in account of last December's movement. All right, let's double check and look at our equity line. Equity curve is for a volatile product that's only taking short, not bad model whatsoever. And again, this is not a real sophisticated program, but it is something that gives you 70% of the trades are winners. The average winners are exceedingly greater than usually the losers. As you can see, we have about the same. It's only short only because we have a max profit target set in there. And that's how we've come to use this program. Now, using the Algo 17 with the TSI, there's a couple things here. We do not have a trailing stop function in place. As you can see, these are compression, dynamic. We have 3 different models of stop functions that you can program and optimize. And we have a start trailing percent of the profit to lock something in. So this is something, again, for more of an algo class that we do. And for the record, we are conducting a seminar down here in South Florida, which we'll be going over this particular program to help meet the needs of a lot of you guys that want more education in algo programming, as well as the V2 Algo 17 program. Now, let's look at a couple things. Where are we headed for this market? Yesterday's sell-off was on at the expense of, let's take a look. We were at one point yesterday, almost, if I look at the S&P 500, at one point yesterday, we were almost forming the equal and opposite. The advanced decline actually had broken back up, testing the highs for the week. With stochastics, yeah, generally speaking, overbought. It was a wall of worry. Volume, my proprietary volume indicator, was also not showing that this market was generating that true strength. So again, it wasn't something that we were excited about, but we said, don't give up on me yet, baby. It was the title of the topic. Why? Because the market could have rallied a little bit more and done what we call an Arthur Merrill M11 top. What does that mean? Sometimes you get higher secondary highs and then you get a rollover. So we were kind of using a little bit of caution in the marketplace, and number one. And number two, now that we have broken out of we broke out of an old peak high, broke out, and now we've broken back underneath it. So where do I suspect the market's going to go? Quite frankly, I would not rule out with the S&Ps. Again, my 2 cents is a daily weekly close under 296, as I wrote in this week's newsletter. A daily weekly close under 296 projects a move possibly as low as right here, right where the whole kind of party started again. And minimum objective is around 286, so a 10-handle breakdown. And I mean, quite frankly, we almost made most of that so far with follow through today. So that's where we stand in the market. We did lose the advanced decline, as you can see, in the S&P 500. Now, this is the advanced decline on S&P 500 broke down. Our volume indicator showed divergence. So at this point in time, I would say it's highly likely that we get in time more downside. We broke below the 20-period MA, so the trend right now, maybe we can get a little two-sided movement in the month of August, but overall, I think we go lower from here because this failed, and number one, it failed on significant volume. Significant volume. How significant was it, John? significant. So that's the moral of the story. Is it just S&Ps I'm worried about? No. Let me show you a situation here. I'm not suggesting that we're going to get a crash to biblical proportions, but I'm not buying the break. And if I do, it's for a scalp on a day trade. What I see is that we've got the moving averages of the advanced decline. Short term is the yellow line, longer term's the blue line. It broke down and now have a short-term moving average below a longer-term moving average in the advanced decline line. That's not positive in the S&Ps. Same situations developed here with the Qs. Same situation developed here with the diamonds. Same situation is developing right now in the NYSE, and that's what a lot of big technicians look at because they don't have the ability to look at all of these other markets. So a lot of wealth fund managers, a lot of guys that are institutional traders, they're just relying. CNBC, for example, Bob Pisani's a good guy, and he does pretty good work, by the way. And Bill Griffith, good guy, by the way, in his own rights. He's I wouldn't say, maybe he's not a closet case technician, but he's he's out of the closet, so to speak, as a technician. So with that said, there's some people that don't like you to know that they use technical analysis, right? But Bob Pisani often comments about the breadth of the market. But what does he do? He comments regarding the NYSE, the ARMS index, NYSE, the tick, NYSE data. We try to break down all the stock indices that we're trading. That's what I did. That's what we created here in the TradeStation platform that you're seeing. And that's why I share it with you. NASDAQ Composite. You can get the advanced decline comp ratio both for the NYSE and NASDAQ, even on Thinkorswim, my brethren, love of my heart trading platform for options, as everyone knows. But TradeStation really and Trade Navigator. Those two platforms, it was actually Trade Navigator, a little history for you, in 2009 that I asked them to program these pages for me on Genesis Financial Technologies platform. It is probably one of the best analytical platforms out there. I still use that program. But moving forward, what about the Russell? We couldn't break out over overhead resistance. Volume was divergent. You can see my volume indicator is moving lower. This volume tool is a tool that bases just a momentum indicator A, but the values are not taken from relative expressed changes of volume, but rather percent change of volume. So it's a very sophisticated way of filtering out volume trends, giving us a better idea of volume. I didn't invent volume, and I didn't invent a momentum indicator, but I did decide to change the way we look at volume to help uncover better volume patterns to give me an edge in the market. And it's called modernizing the tools that we use in this day and age. And I think that's what a lot of traders lack, modernizing tools. So with that said, on balance volume definitely did not at all give you a divergence setup like my volume indicator did. And if you use just this OBV and the breadth of the market, the advanced decline, I think you got trapped because the advanced decline did pop up its head and make a new high and then puked. So what's the moral of the story? Let's take a look real quick and I'll share with you what I mean. There is the advanced decline. It popped to new highs. The on balance volume was rising. As you can see, our volume indicator, significant divergence. So what happened? We couldn't get through the highs, and now the Russell, the small cap, back into trying to test maybe the low end of its trading range. We'll see how well this supports if we get into our person's pivot, which is probably around 147, let's call it. 147 up to around 148.5. Those will be the big numbers that we'll see if we get down into value. And by that time, I'd like to see some kind of a generated strong volume convergence pattern and a good breadth reading in the IWM. So right now, let's face it, every single stock index is all in sell mode. Everyone has a definitive reversal in advanced decline and on really strong negative volume. Does not tell me to buy dips right now. All right, so moving forward, what happened to our trades? Yesterday, as I was pointing out in our Algo room, and we did a webinar last night, what I wanted to point out, this is the Algo 17 Extreme. As I always try to tell people, listen, if you want to go short the market and our system is long, why don't you wait till it gets out? And one other thing that I wanted to point out is this is that volume indicator I was just sharing with you. Notice as the trade got long yesterday on good volume, which I supported this trade and I thought it was a great trade. It gets out of half the position, and these little lines in the sand that you see here, those are our combination of last conditional change and our stop functions that we use. We have 3 different types of stop models that we use. Last conditional change, an ATR and a last conditional change average, and then a compression type stop, which is extremely advanced, that tightens the stop as the trend moves forward like a rate of change. So it's very sophisticated in that sense. And if your stop is too far away, it overrides one with the other. That was a little hard to explain, but that's what we were trying to do in the webinar last night, is explain the difference. Now, yesterday, again, we have this potential like double top in the market. The system goes short. It goes short with what we thought was going to turn into just a mild scalp, a little divergence, a lunchtime sell-off. Give us 5, 6, 7, 8 points in the S&Ps. And what did it do? It did a beautiful job and got out of half the position, and then President Trump, boom, and the market just melted off. Now that was a very powerful analytical trade that generated an insane trade. Now what about the prior day? Well, the prior day, it went short and got out, and it missed this huge move. Why? Because by the time it went to get into a new trade, the risk factor was too great. That's why. So just to give you an idea, what is the performance in this? So here's your performance graph. New highs. Yeah, there's some drawdowns. I get that. This is a 5-minute model, number 1. Trading 2 lots, number 2. And only trading during the hours of 9 a.m. and let's review. I'll share the secret with you. 3:25 Eastern Standard Time. It gets out of any trade at the end of the day. That's it, gang. Max risk on 2 lots is $600. Max profit was $17.20. This is the model that we have in our room. So this helps our traders to say, hey, we've got the TSI indicator, which means if the 5-minute and the higher time frame is in a sell, the stuff turns red. If it's white, it means the short term is in a buy mode, and when it turns, when both are in sync, and look here, this is exactly what happened. This is a state-of-the-art, picture-perfect John Person methodology trade. This was huge money, huge money. I mean, you think about this, short from 09, and you get out of the bulk of the trade at around 67. Huge day, right? All algo driven, up, down, beautiful stuff. Now, when you look at this trade, you go to yourself, all right, well, this is good. It's a once-only type of trade. What are the other models doing? Well, today, same stuff, same stuff. What happened today? Real simple. Why did it miss the trade? Because by the time it gets a sell signal, gang, the risk where your stop has to go on that particular trade from a model, it was on 2 contracts. It's risking almost $2,000. Way too much money. Our model, I just shared with you what the risk is. It won't take that trade, so it didn't. What about the 15-minute model? And that's one that we also use, and I want to share this with you because that's what we use in the live trading room. Let's take a look at a couple things. 2 days ago, it got short because it's on a different time scale. And by the way, the risk was negligible on that. Gets out of half, trails a stop. Got long yesterday, as we shared with you. Got out of half, trailed the stop. Thank God it did the same thing yesterday, the 5-minute did. It went short and it made banked money. This morning it went short. It covered half the position. The darn thing is still short. It's currently 11.44. It does have emergency stops, and the last new compression stop has not kicked in on this trade. This is currently live, and this is what we're projecting in our trading room at this particular time. So I just wanted to follow up with what I stated yesterday. Hey, don't give up on me yet. We had strong advanced decline. But, you know, longer term, the market was not showing great resolve. If we had closed the week out on a positive note, if we'd closed yesterday on a positive note, guys, this could have been a really unbelievable breakout to the upside, especially in the mid cap and especially in the small cap. But it didn't break out. And right now we have market sell-off. So the moral of the story is, A, I'm not looking for next week, there's not a lot that's going to really alter the mindset of the market unless some deal happens, and that's what the market wants to hear. I don't know if that's really going to happen, but there's no real big economic numbers. We're pretty much through most of our earnings. Congress is in recess right now. So really the only thing we have to really enact any confidence in this market is any deal with President Trump. If Congress is on vacation, a lot of hedge fund managers go on vacation in August. And so this is entering probably the worst time of the year to trade the markets. And a lot of people would say, hey, I'm out of the market right now until things calm down. And so for that reason, next week, I'm expecting potentially a contraction, maybe later in the week, a contraction of volatility. And that means we want to be tightening up our analysis and our modification of our trading programs because the ATRs went too crazy. I hope I didn't say anything that was too advanced. I want to expressly share with you. When you get really big movements in market performance or huge trade ranges in a market, generally you get contraction, and that contraction can lead to drawdowns. So for our algo trading room, next week we're on guard for that. I think also we'll be watchful for other opportunities in crude oil. Now, yesterday, as I mentioned, the crude oil market, our program was short that trade. Guys, if you're not joining this trade room, I don't know why. It's $149 a month, number one. You get to see all these trades live in front of you. You can piggyback these trades and trade anywhere you want, whether it's Thinkorswim, TradeStation. You could trade at Interactive Brokers and take these trades on your own. You can use it to piggyback and make sure that you're on the right side of the market. We are seeing dynamic changes in the market, and we are seeing, again, pretty substantial performance. Again, these trades you'll see here, this starts at 7 a.m. plus 85 minutes. So that's literally, if you think about it, that's starting at 8:25, ends at 2:25, at 2:15, because it subtract 10 minutes off of 2:25. So 2:15 is the time this, and I'm pointing to the screen, sorry. 2:15 is the time this market stops trading. This is kind of a pretty decent market for us to trade in the crude oil. The performance summary, it does pretty well. We can always do better. I mean, this thing, 723 trades, whew, it's a lot of trades, but again, performance graph, this is not our rollover model. This is the one that we maintain, because crude oil, just expressed to you, is the biggest pain in the neck for an algo program, because volatility fluctuates and every month we roll over. Every month we have to maybe do a maintenance check on our model. So I just wanted to tell you that. But again, this is a model that does expressly well, and it's a 5-minute trading system. All right. So that's our crude oil. Then again, our VIX, our spider, as you can see, has done exceptionally well this year. These are the trades that we put out. This is the system. You see this day in and day out. I encourage you to try to give us a look-see. If you're in a trading room and you're looking for performance and you want to trade volatility products, S&P products, if you want to trade crude oil, if you're not a day trader, then at least take a look at what we do here, trading the spiders. That's the S&P ETF. And again, you'll have opportunity that when we see trades that are populating, like in the British pound, or more importantly, like gold. And here, let's take a look at gold performance. This is gold. I think if you're trading GLD, this is one that at least you could say, hey, I mean, for a 5-minute day trading model, what times does this trade, John? Well, this trade's starting at around 8:55 in the morning, and again, it ends at 2:25 in the afternoon, or minus 10 minutes is 2:15. Same thing. So it doesn't have huge risk. Look, max trade loss on 2 contracts at $290 out. This is part of the mechanics. Now we have different stop functions that we implement here, as I pointed out. Last conditional change, dynamic, and compression. And that was what we were going over once again in the webinar last night. So if you didn't make it, watch for a replay. Otherwise, if you want more information on how you can take advantage of these signals in front of you, go join us here at personsplanet.com. Thanks for listening, And I just wanted to follow up with what we said yesterday. What are the systems? How did they end up? And what are they doing right now? Because it's a pretty wild and wacky world. And watch out for next week. I think that in the next couple of weeks, we do see pressure in the market, A. B, there's not much to really recover this market, so we're going to be under pressure or at least see values constrict before we see another leg up. And the next leg up is going to have to come from some form of stimulus or confidence that we're not seeing a drag on global economies, which again is the, let's face it, the big trade war tariffs between the U.S. and President Trump trying to get China from stop ripping us off. And that's bottom line, at least with our technology, our secrets. And again, the copyright laws in China means they have the right to copy our stuff. And I should know because like some of my friends in the technical analysis community, whether it's John Murphy, Steve Nissen, myself, most of us guys, our books have been published for free. And so, and I can't imagine not only that, but look at all the technology companies. And I mean, I'm just a little flea on not even a dinosaur's rump, right? I mean, I'm just a small potato in that world. But the point is even my own work that's been copywritten and published through John Wiley and Sons, and you can find my books on Amazon.com. Number one, they're all for free in China. So anyway, go President Trump, try to get us a better deal, and I'll see you next week. Have a great weekend. Thank you, everyone.